We've got Mark Todd from FIIG Securities standing by with us right now from Sydney. And Mark, we were just hearing from Cam Peacock there. The market's only pricing in one rate hike in the next 12 months, which is interesting because in that Westpac survey today we're seeing consumers extremely worried about further rate hikes. Do you think that the market's on the money? We're just pricing in one?
I do. I mean, I think the market has, over the course of the year, been very volatile in its expectations. So the market has been pricing at the start of the year maybe 4. And now, since the last numbers came out, since June, they've all started to say there's now only going to be one in the market. I think if we looked at what the RBA was saying, they were going to review it at the end of the year. I don't see that changing. You know, there may be one more left in it at the end of the year, but at the moment everything looks fairly soft.
And Westpac, with their release today, saying they're not seeing an opportunity for the RBA to raise really until November. But what do you think has shifted those expectations, as you said, perhaps since June? Was it anything, any release in particular?
No, I think the numbers have been consistent with what the RBA was looking at. They said there was going to be a softness around the ASIA, around all the different, natural disasters that we had, and so it was just a function of when the recapitalisation of the country came back online. It'll take a while, and common sense would tell me that with the currency over 105, it's going to be very hard if you're a farmer, if you're in retail, if you're in tourism. So the RBA is conscious of that, and they've made their points. I think market watchers look at every word they write and say, and so that created that volatility. But the RBA still said, it's going to be at the end of the year before they review it.
Yeah, we had Warwick McKibben making this case that perhaps we talk too much about the economy, and where there's almost too much transparency, you get that volatility. Do you think that's right?
Yeah, and McFarlane said the same 2 days ago.
Sorry, McFarlane. I'm thinking McFarlane. I'm saying McKibben. Apologies. Yeah. That's
right. The case against that would say that it's good to have the education, to be an educated market. So the government would say we want financial education, financial literacy everywhere. But to the end degree, we pay a lot of people a lot of money for their advice, and so they look for every opportunity to provide that advice, and it's not necessarily relevant. So some of the analysts need to write something on paper, and so they're looking for every language, every word.
In this Westpac survey today, Mark, we've seen respondents who are nominating bank deposits as the wisest form of savings increasing from 27% in March to 32% in June. And Westpac says since 1979, this proportion's only been exceeded December 2008 and March of 2009, when people were most concerned about where things were going. Are you seeing that reflected at your end?
Yeah, the deposit book at FIIG is very robust at the moment, and I think there's a lot of interest around the deposit space just naturally. We're of the view that there's been a change in the psyche, and we don't know how structural and permanent that change is. Everyone would have put their money in equities, they would have put it into fund managers who are into equities, and now with changes in the structural nature of Basel III and the demand of the banks for deposit markets to avert having wholesale markets means that deposits are very attractive to both the lender and the borrower, and so we've seen a change in people's view to deposits as an asset class.
So are you still seeing good rates being paid on deposits then?
Yeah, there's a shift around. If you can imagine, the curve is, the bank is saying that we don't want 30-day money. That's that volatility in 30-day money by the nature of its asset. They want that 1 year money, and I think they're still prepared to pay up. It's from 6 and a quarter to 6.5. You'll see some other institutions will play 6 3/4. It's longer term funding are attractive rates for people.
Okay, so the 1 year rates looking pretty good. Yeah. What are the expectations for those rates? Do they stay good? Do we see other kind of other terms come into popularity? I don't know.
Yeah, I think if you look back at what Bill's saying about the growth in the deposit market, as it becomes more acceptable to be having 1 year investments, so in the middle of the global financial crisis, if you went to somebody and asked for 1 year money, it wouldn't have been popular. Now, as we get more comfortable with having 1 year investments with the banks, you'll see that the bank will start to offer 2 and 3 year, and they'll look for variations. They'll look for floating rates for 18 months. So they'll just continue to expand that curve through their own marketing.
And do you find that they offer those 2 and 3 year rates to investors who already have the money in there, or are they kind of advertising those rates more widely? Or will they? I guess this is an outlook for us, but...
I think there's, whenever you talk to the banks, and we go and meet with all the banks, there's a natural tension between the marketing arm and the Treasury. The marketing arm will say, well, give me these rates and let me go and do my advertising piece, and we'll just open up the doors and take whatever money comes in. And the Treasury says, well, hang on, you know, at 6 3/4, I don't want to borrow too much. So it's around that tension. So that's why they use people like ourselves to be more targeted. They might want a few, you know, $100 million, and let's see what the market will accept. So it's always a chicken and egg. What rate do they have to pay for cash?
Yeah, thank you so much, Mark. And as I said, extra kind of insights into that Westpac survey from you as well today. So thank you.
Pleasure. Bye-bye.
Thank you. That's Mark Todd from FIIG